Alrighty, good morning everyone on Facebook. Today we got a great episode. We're going to be talking about getting a home loan with Austin Shumaker?
Shumaker.
Shumaker, not Shumaker. That would be...
Hey, yeah, look, I've been called a lot worse,
Alright,
that
so
works as well.
we're going to be talking a lot about getting a home loan, what's required, what's the processes, what are the do's, what are the don'ts. We'll also get to know a little bit about Austin, where he's from, and just kind of how he got to where he is. And if you guys have any questions, feel free to ask the questions. So with that, and so before we get started, we have a couple of sponsors that I'd like to read off. And the first one is the Music Academy of Acadiana. Acadiana's top choice for music lessons: piano, guitar, voice, drums, violin, saxophone, all of those good instruments. Audio production, you can learn that there too. They are a local company founded by Tim Benson, who is a University of Louisiana at Lafayette Music School graduate. And founded locally, like I said, they have about 500 students enrolled. Very busy place, but very talented owners and musicians and teachers and instructors, all those good things. And so they've won several awards locally and nationally. They've even been seen on American Idol and The Voice. So great local company. Their goal is to make music lessons fun, educational, and to help foster the next generation of musicians and creative thinkers. You can check them out at their website, which you can see on screen, musicacademyacadiana.com, and on Facebook, Instagram, all those wonderful places. And then we have our tech sponsor, The Orchard, Acadiana's only Apple authorized service provider. So if you have a cracked screen, or if there's an issue with any Apple device that you have, they will repair it or replace it up to all of the industry specs of Apple. They have to follow Apple's check boxes, so they can't do anything outside of what Apple will allow. So super structured, super formatted to Apple. So your products will work exactly how they should if you go in there and need it a repair. They also do in-home and in-office networking too. So if you need any kind of networking, they offer that. And you can check them out at theorchardstores.com. Alrighty, and so Austin, thank you for coming on to the T.
Yeah,
podcast.
Thanks for having me, Ben.
You're welcome.
Appreciate it.
So I want to just kind of get to understand a little bit about you and ultimately how you became a home lender. Mm-hmm. I guess a mortgage originator? Is that what the correct term is?
Those are ubiquitous, but same difference.
So tell us a little bit about that process and kind of where you're from.
Yeah, absolutely. So, born and raised in the metropolis of Maurice, Louisiana, 6 miles south of Lafayette. Kind of grew up half the time there, half the time New Orleans. So, got a little bit of the
big city
country scene and the big city life. Really started out going to UL and did a brief stint in the oil and gas industry. And then the crash came, and we all were kind of like, all right, what are we doing now? And the short story is I was coaching CrossFit. A guy was like, hey, why don't you get your MLO license, your mortgage loan origination license? And I was like, okay, I don't know what that is, but yeah, let's do it, right? Why not?
And what year was this?
This would have been in 2015.
Okay. Yeah, oh, wow. So that was recent.
Late 15. Yeah. So I've only been in the business, 6.5 years or so. So I did that for a while, worked for a couple of guys for a year and a half, 2 years, and then, kind of branched off and started my own gig.
Okay. So you were in the oil and gas industry before you became a mortgage loan originator. What were you doing in the oil and gas industry?
Yeah, so I was kind of a boots on the ground. I was kind of the CEO of a company's right-hand man. We were in the environmental sector of oil and gas. Worked out in West Texas for a while, back into New Orleans for a while. And, when the going got tough and the financing wasn't as great, in terms of the price of oil in terms
Right.
of commodity prices. The revenue streams just weren't there, so they started laying people off. So I was a product of that.
God, yeah. So and so many other people were. It's a tough industry to be in, especially now. And I guess that's moving more environmentally clean energy.
Right.
They're trying to do that, but I think we're still going to have a pretty large dependence on fossil fuels forever.
Agreed. Yeah, I mean, it seems like there's actually a little like renaissance happening right now with the commodities prices moving up. With kind of a byproduct of inflation.
Right.
Commodities always go up.
Speaking of inflation, all right. So the past couple of years have been wild, obviously, with COVID.
Yeah.
And home prices and mortgage interest rates have been just kind of been crazy.
Yeah, it's been bonkers. It's been crazy.
It's been insane. Tell me a little bit about like what it was like post, I guess, prior to COVID, and then what it's like now. Like, what was before COVID like for you early on in your profession?
Right. Yeah. So as we say, BC before COVID, mortgage rates were, let's say anywhere from 4% to 5%, right? Or maybe even sometimes high threes, kind of just depending on the term, the product, whether you're doing a government-backed loan or a conventional loan, how much you're putting down. People always kind of ask us that loaded question of what are rates today? And I was like, well, what's your credit? What program? It's a loaded question.
There's no set amount. Like you can Google it and get an average.
Yeah, right. An aggregate of everything. But, typically you'll see the rates that are posted are going to be for a conventional 30-year fixed rate. That's the bread and butter. That's kind of what gets advertised.
Right. So around 4 or 5% would be the norm,
correct.
I guess.
Yeah, maybe even in the mid fives, at that time. And then COVID happens. We kind of get this economic scare where everybody's like, the economy is in free fall because we're shutting down. I mean, I can remember at that time, we didn't really know what was going to really happen to mortgage rates. I mean, they kind of were seesawing back and forth. One day you'd look at the market, they would be higher. One day you'd look at it, they'd be lower. It was kind of a week-to-week thing. And it was only like a few months into, and it was like, okay, the reality is that they're going lower, because the 10-year Treasury is moving lower. The stocks are moving. I mean, they were in free fall at the time. All the major indexes were in free fall. I feel like they're in a
free fall right now.
They're going that way.
God.
Yeah. But, I guess to answer your question, post-COVID, we saw this renaissance in the mortgage business. I mean, the greatest kind of refinance boom, as we call it, to ever happen. I forget the amount of mortgages that were originated in both 2020 and 2021, but it was, they were record years, year after year.
Well, yeah, according to all the real estate professionals that I know, like inventory just in homes is so low. Like, homes are selling like freaking hotcakes.
Right, and I can't speak to what typical or what the inventory is today, but and a real estate agent can probably correct me on this, but I think we used to hover in this MSA or in this MLS around 3,000 to 4,000 homes at any given time that were on the market, and I think right now it's 1,000 to 1,200 or something like that. That's a pretty big disparity.
I believe we actually got as low as 500 homes at one point.
Wow.
And I think in Acadiana, there's maybe 1,400, probably more now, real estate agents on the books. And I don't think that's active real estate agents.
That's total that hold a license.
I think that might be total, or that could be active. I can't remember the exact terminology that was told to me, but 1,400 was a number that was mentioned. And to know that out of 1,400 real estate agents, whether that be active or total, 500 homes, there's not enough homes for those real estate agents to sell.
That's right. So definitely interesting.
Yeah, so it's been really wild. Like, what are, I guess, the people that are getting loans saying? What are their reactions to the market? Are they telling you anything, or like?
Right. So as you know, we live in a very hyper aware 24-hour news cycle that everybody is very cognizant of now, and it's like the first signs of the market moving in a negative direction, meaning rates are going up, is kind of a frenzy to rush to your loan officer and say, hey, what are we doing? What's going on? We need to refinance now or lock in now. That's kind of the prevailing sentiment right now, where we have a lot of people that are buying new construction homes that are, say, 60, 90, 120 days out. And it's like, hey, what are we going to do? And it's, unfortunately, you're kind of between a rock and a hard place.
Speaking of experience here.
Yeah, right, exactly.
I have a new home that's getting built, and it's, we're waiting to get that locked in.
Yeah. So, I mean, you're feeling the pressure right now, I will say that, historically speaking, rates are still, like, incredible, They may be a point higher than they were last year. But
what is a point?
So a percentage point, like 1% higher.
Okay, got it.
So what was a rate last year, maybe in the high 2s, maybe in the high 3s today. Okay. But still, like in the grand scheme of things, if you go back 20 years, still an incredibly low interest rate and still very affordable money long term.
Yeah.
Right?
Yeah.
And
so I guess I want to talk a little bit about, like, what would be some of the things that a new home buyer, let's say first-time home buyer, never, like, they're renting right now, they want to get out of a rental situation because they're being told by family members that they're, for lack of my better words, pissing their money away.
Sure.
What would you tell a new homeowner or new first-time buyer?
Right.
What advice would you give them?
Yeah, absolutely. So the first step is really going through what we call, like, the pre-approval process. So, like, what you did when you called me, you were like, hey, look, I need to figure out what we can spend, what the rates look like, what the monthly payment looks like. So we aggregate a bunch of information, which is, what your employment information looks like, what your income looks like, your assets, credit, liabilities, job history, and all that stuff. And we aggregate that, and that kind of tells us, hey, you qualify for these programs up to this amount. Here's what the down payment options look like. Here's what if you're a first-time home buyer, let's say, here's what those options look like, because there are some programs out there. And it just gives you an idea and a range to set for yourself in a budget. If you're spending $900 in rent right now and you want to say, hey, I want to cap it at $1,000 a month. Well, how much can I spend? And what's the reality of that?
Yeah.
That's our job as a loan originator, is to give you options. And more so than that, as a mortgage broker who has multiple paths that we can go through in terms of lenders, so different programs, different offerings, we can place that borrower in just the right bucket that they need to be in that works for their particular situation. Because not every borrower is going to fit a conventional loan with 20% down, right?
Right.
And that's not the reality. There are 3% down options. There are 0% down options. And that's our job, is to really give the facts to the borrower or to the prospective home buyer so that they can make an educated decision,
So speaking of putting money down, our first time home buying experience, we didn't have to put any money down.
Right.
What loan would that have been? I can't remember.
Yeah, so there's a couple of loans, or a few loans, that you can structure to put no money down at all. So the first of which is very prevalent in this area, it's called a USDA, so U.S. Department of Agriculture actually federally guarantees these loans.
Is that a rural
It's
situation?
a rural development loan, okay. Right? So they are geographically limiting. So you're not going to find that loan product, or it's not eligible in downtown Lafayette. Right. Kind of got to get on.
There's no agricultural situation.
That's right. And the program was developed to stimulate growth in these outlying rural communities. So think Maurice, from where I grew up.
Oh yeah, very rural.
Right. Yeah, very rural. Yeah. Karen Crow, Youngsville, Broussard. There are even some areas of Lafayette that actually qualify for it. But the product is 100% financing, meaning you have to put no money down.
And you said this is government backed?
It is, by the federal government, by the Department of Agriculture, actually. So Congress appropriates money every year for the program for them to operate, and they federally guarantee the loans. The interest rates are great. They're better than conventional rates because they're backed by the full faith credit of the U.S. government. So the lenders are like, well, hey, look, that's not much of a risk, right? Or it's less risk.
Yeah, so less risk.
Yeah. And then, the second option would be a VA loan, which is a great option. It's limited to, correct. So Veterans Administration administers and federally backs those loans as well. But a great product because you get the great rate without some of the caveats of having to put no money down, like PMI, right?
Yeah.
So private mortgage insurance. So those are great offerings as well.
Okay.
Yeah.
Man, it's wild to go through a situation when you're having to buy a home and having to learn all this stuff. We're in our second rodeo.
Yeah.
The first rodeo, it was interesting and it felt relatively easy. But there were some scary parts, like knowing how much the loan was going to be per month, and looking at my itemized bill and like seeing
Right.
PMI, and I was like, why am I paying PMI?
Right.
Like, what is that?
Like, what value is this to me?
And it's probably not much value to
Right.
me.
Right.
I think after doing a little bit of research, and you can correct me if I'm wrong because I might be,
Sure.
is that it's essentially there to protect the lending party.
Correct. So I guess in a way it does provide value to you because you're putting less than that 20% down the requirement. So that's the value. But the value to the lender is like, hey, look, if Austin or Ben don't make their mortgage payment and they go into default, it's some protection for them.
Right.
So, yeah.
What are some things for first time home buyers that they should not do? I know there's a bunch of things that I've seen on the internet, like of people, like real estate agents screaming, like, "Why did you do this?" Like, what would you tell a first time home buyer not to do during the process?
Yeah. So during the process, so if you're under contract or even if you're just getting a pre-approved, I always tell people that my number one thing is like, look, don't go buy a boat tomorrow or a car or anything. Don't finance anything. Don't open any new trade lines. The ones that you have that are existing, sure, keep using them like you normally would. Don't run up a huge balance, but still live your life. But don't finance any new items or don't open any new trade lines. That's the first and foremost. Secondary to that is any like large transfers or anything over like $500 usually is kind of a round number that we say. And if you do need to do that, get with your loan originator or your loan officer, and they'll kind of advise you, hey, look, do it this way, or here's how we need to document that, et cetera, et cetera. Okay. Those are the two really big pitfalls that we see. So yeah.
I may be guilty of the latter, moving money around, but it's but today, especially during the COVID pandemic, a lot of people are doing business online, using Venmo, PayPal, Cash App, all these things, and some people have even started making money via YouTube and TikTok and all these other places where they get large sums of money coming through.
Correct.
Like, what advice would you give someone who's like got a lot of transactions like that?
Sure. So the industry has adapted, right? So the way we do business in the gig economy, it isn't very different than 50 years ago or even 10 years ago. Very, very different. And what I would say to people like that is really every situation is different. So it's hard to make this kind of catch-all statement that would be like, hey, you need to do this or do that. What I would say is reach out to your loan officer. Get with them, tell them your exact specific situation and how you're getting paid and how you're moving around money and stuff like that, and let them give you recommendations on what would work for your specific situation.
Okay.
Yeah.
So now I want this. I'm kind of going backwards here with the apartment rent thing.
Sure.
And this is probably subjective. If somebody is interested in owning a home, but they feel that renting a house or an apartment is more affordable for them. This is obviously has nothing to do with the loan, but if somebody were to approach you and say, would it be beneficial for me to live in a home versus renting, or what has anybody ever asked you?
Yeah, 100%. And I would say the benefits far outweigh the drawbacks of not owning a home or of owning a home. First and foremost, especially right now, it's a great hedge on inflation, which we all know. We see it in the news every day. It's like, oh, inflation is real. It's no longer transitory. I've heard the word transitory so many times now. But what that means is you're locking in a rate on long-term financing at historical lows, which is, guess what, never going to change. But during an inflationary period, wages go up, groceries go up, gas goes up, but your mortgage payment will remain the same. So it's a great, what we call hedge on an inflationary period. It's a great
And this
thing.
is for mortgage rates.
Correct. Yeah. Exactly. Yep.
So someone renting, I mean,
their rent is probably going to go up because guess what? The landlord's
every 6
cost
months
of doing business is going to go up because there's inflation there.
Gosh.
Right? So that's an interesting way to think about it.
Yeah.
The second portion of that answer is, buying a home and owning a home and paying into that asset is one of the greatest ways to build wealth in the U.S. and in the world. And it's really like the first step of building wealth in your financial career, call it, because you're paying down that mortgage every single month you make your mortgage payment, as opposed to when you're paying rent, you're just guaranteeing you a place to live, right?
Yeah.
So it's not really paying into anything.
I hear a lot of people saying that getting into the real estate market, like you said, is the quickest way to build wealth. Right. I know several people locally who have done that by flipping houses, and it's a pretty wild situation. And then I'm on the internet all the time, obviously, and there are people that buy homes and build a small guest house on the property, live in the small guest house because they don't need a big house, but they rent out or Airbnb the bigger
short-term
house,
rentals,
and basically use the income from that property to pay
the mortgage,
their mortgage, and to live on the property for relatively nothing.
Yeah, absolutely.
So, I mean, I do that in New Orleans. So my wife and I have a house. It's a 2-unit house. My dad lives in one of the units, and we Airbnb the other unit. We all co-own it together. And, it's a great way, again, to build wealth and also make a little money while you're doing it, so.
Okay. So now let's say, hypothetically speaking, I wanted to get into this. I don't know a thing about it. I just know that it's the quickest way to build wealth.
Right.
I'm being told.
Right.
What would somebody like me wanting to get into that have to do? Like, is there a barrier to entry? What does that look like? Because if it's the quickest way to build wealth, if you need the wealth first, then it kind of defeats the purpose. Like, what does that look like?
Yeah. So the barrier to entry is being able, of course, to acquire the financing for said. You're asking the bank to, hey, look, I want to do this. Will you lend me $200,000, $300,000, $100,000, right? So I would say that's the biggest barrier to entry. But there are ways to hedge that. If it's a long-term rental, do we have a lease on it? Can we use the income that's already being produced in that rental unit? So again, it kind of goes back, hard to make a one-size-fits-all answer to that question because it is so multifaceted. But there are ways to alleviate the barrier to entry, so to speak.
Okay.
Yeah.
Okay.
But the first conversation is either with a real estate agent and just getting the conversation started, which they'll refer, that prospective home buyer or investor to a lender, a loan officer. And then, they can kind of look at that specific situation and see, okay, hey, can we or can't we? And if we can, how do we go about doing it?
Got it.
Yeah.
Okay. So we covered some of the don'ts. What are some of the do's? What should people do, I guess, to ensure a smooth mortgage loan situation?
Sure. So first and foremost, I would say, we always talk about credit, right? Because that's really what a few things are going to be dictated by. So both the loan program that you're getting into, the interest rate, how much you have to put down, what term. So we always tell people, you really want to protect your credit score and start building your credit score from a young age.
Yeah, because a lot of people would start with, is it 555? It's like,
it's
500.
I can remember looking at my credit score when I first started. When I got my first credit card, it was like a $250 secured credit card. And I was like, this is kind of ridiculous. I'm borrowing my own money. Cool. But I pulled my credit score, or the bank did, and I didn't have a credit score. And I was like, okay, wait. So I'm supposed to build credit without credit.
I know.
Understood.
It's like it's like trying to get a job at a place that you really like, but you need work experience.
Right.
But you don't.
Principle.
How do you get it?
Yeah.
When you.
Exactly. So that's typically what we tell people. It's like, hey, look, go get a secured credit card and start there. and then steadily build it, pay off that credit card every month, pay the balance, the statement balance. And that's slowly how you start building the credit score, and financing more things. And, you'll get an auto loan, make sure you pay on time.
Right.
Don't pay late. That's going to really hammer you down. So the first portion of that question is definitely keeping track of your credit score. And that's one of the do's. It's like you want your credit score to be as high as possible.
All right. So speaking of keeping track of your credit score, all right. I'm all of a sudden hearing over the past few weeks that Credit Karma is like the Zillow of
Yes.
The real estate world. I've been using Credit Karma, since freecreditreport.com faded out.
Yeah.
And I've always looked at it like it seems to be pretty legitimate.
Right. Yeah, they wrap it up in a really pretty bow.
Correct. Right. And so, as far as that as far as I understand, the numbers are not like incredibly off.
Right.
But when somebody's trying to watch their credit, most people are going to be using Credit Karma, or some banks have a built-in like credit watcher and gives you like a rough score. Very similar to Credit Karma.
I know, like on my Chase app, like they have their own version of Credit Karma, right?
Yeah, and I have Capital One. They do the same thing. They say, "Hey, do you want to see your updated score?" I'm like, I think I know what it is. So I don't look at it.
Right.
What do you say to people trying to watch their credit, trying to do the right thing, but are using Credit Karma? Most people use it.
Yeah.
Is that something good to use, or would you? What would you say to that?
I would say it's a good tool. I wouldn't go solely based off of Credit Karma because, as you said, it's like the Zestimate with Zillow, right? Yeah. It's just not really based on true evidence and facts, right? It's
like whenever we bought a car several years ago, and I got my own credit score, and I walked into the car dealership like, look, I know what my credit score is.
Right.
Here's the deal, and they go run my credit, and it's different.
Sir, that's not your credit score.
It wasn't far off,
right.
But it was like, I would say by 10 points difference. Like, there's a spread. Like, go ahead and continue your thought, but I just had to...
Yeah. No, so I was saying, it's a great tool, but it's like this estimate. It's an algorithm that somebody built that uses trends, and they do monitor certain things, and you'll notice, like, if somebody checks your credit, they will notify you of that.
You'll get
so
it.
They have tools that they're using. It's just not an actual credit score. So, I've seen where it can be as much as 75 points off, which is a pretty big delta,
That's a big
especially
difference.
when you're talking mortgage interest rates or consumer credit rates. So it's, like I said, it's a great tool to monitor when somebody checks your credit, or if you have a delinquent account, or if you have something in collections, it may pop up there. And that's a great way to monitor things and address them as soon as possible and triage the issues and say, hey, look, I actually wasn't late on that, and here's the proof, because sometimes creditors do make mistakes. So, yeah, like I said, it's a great tool, but not a definitive credit score.
Okay, so use the tool, but use it wisely.
Yep.
Don't use it as Bible.
Correct.
Whether you believe the Bible or not, just putting
Right.
that out there. Okay, so my next kind of thought toward that, like monitoring your credit, and I had a thought. I'm trying to connect it because I have a lot going on. Gosh, I hate when I get right off track. That is the worst thing. Especially live, like people watching.
Yeah.
Okay, all right. What was I going with? Okay, so we were talking about Credit Karma. Okay, I think I'm getting back my train here. It's getting back on the rails. Getting back to, I guess, repairing the credit.
Mm-hmm.
Okay, so let's say somebody has a collection. Mm-hmm. A lot of people tend to do at least once or twice in their life.
Yeah, it happens.
Let's say they're in the pre-approval process and they have a collection on the books.
Mm-hmm.
Like, what should they do as far as that? Obviously, pay it, but what are the lengths of time that falls off? And if it doesn't fall off as fast as it should, if it like stays on the report for X amount of time.
Yeah.
What does that? What do people need to do? What is the responsibility, I guess, for someone trying to get a loan with a collection on the books to do?
So any sort of derogatory credit event or account that's on the person's credit report, it's going to vary from program to program. And that's why you probably are going to get tired of me saying like it's really an individual basis and we got to look at it and we got to do this, we got to do that, because it is so multifaceted in terms of loan program, in terms of credit score. Like if they have a credit collection and they're at this credit score, well then you do one thing. If they have a collection account at this credit score, you do a totally different thing. So it's hard to say, but a good, I guess to answer your question fully would be, collection accounts are on there for a certain length of time, especially if they're not taken care of. There are ways to get those taken off. I always like to tell people like, hey, look, we are not credit experts. We are experts in the mortgage and the loan process. So we have vendors that we use that are really, really great at doing credit repair. Probably everybody that has ever done credit repair in their life has some version of a bad story that's like, hey, it didn't work.
Right. There
are a lot, more often than not, what I've seen, there are a lot of companies that just don't work very great. You pay a lot of money and they don't really perform. We've identified a few different companies and vendors that actually are worth their weight in gold. I mean, they've brought clients from a 580 to a 700 in a 6-month span I've seen. Wow. Which is incredible, right? Because you're saving that borrower so much money. You're adding a huge value to them long term over 30 years, where their rate would have maybe been 5.5%. And now you just scored them a 4% rate. That's a big deal, So I guess to circle back and answer your question, what to do or what happens with collection accounts is really dependent on what type of collection it is. If it's for a housing collection, it's going to depend on the loan program and if it holds some weight and what the borrower's credit score is. If it's a medical collection, we can't necessarily count those against the borrower, but they will affect the credit score.
Okay. So
we can't negatively... it can't negatively impact the loan process. So it's not like if you have a $1,000 medical collection, I'm not going to count a payment against you, right? So like a 5% payment of that balance.
Because medical bills can sneak up on people.
That's right. Yeah, I mean, you go to the hospital and you go to the ER and suddenly you're like, wait, I never got that bill. Oh, and God. I mean, everybody has a story with that.
I mean, that's the worst thing about hospitals. I love hospitals, but you get so many random bills to the point to where what is this?
Right.
And like, especially like whenever, let's say if you're married and you have a kid,
right? Your
wife goes in, gives labor. I mean, there's a bill for the person who gave the epidural. If you got an epidural, there's a bill for the person who, I don't know, like sewed you up and did all this other stuff. Like there's so itemized. Like I wish in a perfect world that it was just like a box of like, here's what you owe. Like, hey, like a menu. Like
here's your bill. Here's your receipt. Like on your way out. Like why can't we just do that?
Yeah. Like and you can go even deeper, and we don't need to do this as a tangent.
Sure.
But insurance, that's a hot mess.
Yep.
A hot mess express. I mean, some people don't even know why they're paying insurance.
Right.
Some people know why they're paying insurance, but choose the cheapest insurance possible because, I mean, it feels like medical bills are expensive no matter if you have great insurance or not.
Yeah. Well, look, I mean, I've fallen victim to it. I had a collection for $12 from Entergy from a house that I haven't lived in 3 years now.
$12. Really?
Yeah.
They couldn't just wash that?
I was like, guys, just pick up the phone and call me. Like, I'll pay you like $24.
Right, like I'll double it.
Like
make it worth your while. Good grief.
Yeah, exactly.
My favorite thing is when bill collectors or whatever have you send so many notices in the mail.
Right.
And the amount of postage that they've used to tell you that you have a bill that's outstanding or a collection outstanding.
Yeah, they could have just
paid. They could have paid themselves back.
Correct.
That's the most ridiculous thing, but we're getting into muddy waters here. Yeah. Okay, so I thought of the B word, and I don't know if you know where I'm going with this, but bankruptcies.
Uh-huh.
Some people have bankruptcies.
Yep.
And I'm thankful that I don't, because God forbid. But what happens when somebody has a bankruptcy on their record? And I think, 7 years?
So it depends on what chapter.
Okay.
So you got chapter 7, you got chapter 11, chapter 13. There's all and everything in between. Those are the most common ones. The time constraints, again, I'm going to hammer down on it, depending on the program, depending on the borrower,
Right.
can be very different.
Yeah.
There are some programs that if you're looking in chapter 13 and you have a payment plan and the court allows you, you can buy a house.
Okay.
Like there's no date that you have to wait after discharge on some loan programs.
Wow.
Others, 7 years. Like they want it to the date of the discharge till you can apply for that loan, 7 years.
Wow.
Yeah. So and everything in between. Yeah.
It's wild.
It
so
is.
let's say somebody has a bankruptcy
And
on their books.
that's the thing. It's like, there are home buyers, do this, once in every 4 to 5 years. The average is that someone in the U.S. buys a new house.
Mm-hmm.
We do this every day. So it's like, we don't expect you guys to know all of this. That's why we're here. We're the subject matter expert. It's our job to kind of guide you through and say, hey, here's what we can do. Here's what we can't do. This is why. These are the confines. Here's where we need to stay. So yeah.
Yeah. The B word, such an ugly word.
It is. But it happens.
Yeah, it happens. It happens to some like pretty wealthy people too.
Yeah, no, I mean the financial instrument is there for a reason. It's so that you're not ruined for the rest of your life. It's like you can have a life after bankruptcy. During bankruptcy.
Yeah.
I mean it's there for a reason.
I feel like my limited view of what bankruptcy is, I feel like it's jail.
Yeah.
I feel like I hear bankruptcy, you're in jail for freaking
Right.
part of your life.
Right.
Like that's what
Can't do anything.
Like that's what it feels like.
Right.
You when you watch movies or you hear about people hitting bankruptcy,
Mm-hmm.
like you're handicapped
Right.
to some degree.
Right. And you are. I mean, there are totally like negative repercussions for having a bankruptcy. Like your credit score is diminished. I mean, a ton, right? Because the creditors and the bureaus, so Equifax, Experian, TransUnion, they see that as a derogatory credit event.
Probably like a full reset almost.
Yeah, I mean, it's not great.
It's not great.
It's not what you want, but
it's like playing Monopoly when you hit the bankruptcy thing. Oh,
that's
God.
right. But like there is life after bankruptcy in terms of getting a mortgage.
Okay,
So,
well that's always good news if
It is.
anybody's facing that out there.
Yeah.
And I think I don't know for a fact, but I'm pretty sure the big man Trump has had bankruptcies in his life
I think
too.
like 4 or 5.
Yeah,
I mean,
like-
don't quote me on that, but
I mean, but he's over there willing and dealing like
Right.
businessmen do.
Look, sometimes you have a deal that doesn't go great, like that's
Mm-hmm.
out of your control. I mean, hey, like I said, that's why the financial instrument is there.
Yeah,
know, so
crazy
that-
times.
Right.
All right, so we're getting close to the end here. I guess I kind of want to know, just kind of where do you think we're headed as far as a mortgage landscape, a home buying landscape, and kind of, what does that look like if you can kind of put your best finger on it
Right.
for the next 6 months? Let's just, because I know a lot can happen.
Yeah.
Even in 3 months.
Well, like I always tell people, if I had a crystal ball or if I knew what was happening with mortgage rates, I'd be working at the London School of Economics, and I am not. So, but basically, home prices are rising, interest rates are rising. So, I think in the next 6 months to a year, we're going to see where affordability diminishes a little bit. So whereas somebody who could have afforded a $300,000 house or a $200,000 house can now only afford a $280,000 house or a $180,000 house, I think that's going to be the biggest thing that we see happen is we're knocking on affordability's door, and it's like, hey, we're not letting you in. So I think that may have an effect on inventory, hopefully. So we start seeing more inventory come into the marketplace because this feeding frenzy kind of slows down a little bit. But who knows,
Yeah.
I mean, the lack of inventory right now, I would imagine we can't catch up to a normal, sustainable level in 6 months. You know what I mean?
Yeah.
We'd have to see some pretty drastic
and a lot
changes.
of people, a lot of real estate agents, both locally and out there in the internetverse, they're talking about this bubble.
Yeah.
And like, is it going to pop soon or are we in it forever? Kind of, if you look at inflation in the past, when we enter into an inflation zone, we rarely go back
Right.
to where we were.
Well, especially when you have wage growth. I mean, whenever have we gone through a period where we hit wage growth and then wages went down after that?
Yeah.
It doesn't really happen, you know.
I mean, once a wage is set, like right now, I think the average was what, $10-$12 an hour.
Yeah,
like for almost any
there.
position.
Yeah.
I know Mickey D's is starting at $10 an hour.
Yeah.
Some of them 15.
Yeah.
I mean, there's been a big push for minimum wage increasing too. So
Sure.
Inflation is it's there. I don't think we're ever going back. But like, does that impact home buying forever in the future? Like, or
so it's interesting. I mean, now that we're speaking about like wage growth and income growth, home prices are growing, but so are wages with it. So the hope is that those two naturally kind of progress with each other.
Yeah.
But sometimes the wage growth is lagging the home prices.
Okay.
So hopefully we'll catch up. But I think that's in the next 6 to 12 months. That's probably going to be the biggest factor.
Yeah.
So,
Yeah. Wild times that we live in, man.
that's for sure. That's for sure.
I enjoyed our conversation. I know that there's probably so many other little avenues that we could have kind of tucked in.
Yeah.
But I'm noticing a pattern, and it is the fact that every borrower's situation is unique to themselves.
Extremely.
To their financial situation, to their job situation, to what house they want, to what type of loan they want. So before we go, I want to, I guess, kind of touch on kind of your company before we go out. So your company is Neighborly Home Lending. You have a PDF that you sent me. So you guys started out with 2 employees and you've grown to 18 employees. Is that locally?
Yeah, so one in New Orleans.
Yep.
So about 25% of my business is in New Orleans. So me and another loan officer are there. We have an office there. And then the rest are here based in Lafayette. So all of our operations are based core.
And you founded the company.
Yeah.
Got it.
Yeah.
Awesome. And so you guys you utilize technology that gives the clients and the referral partners access to at their fingertips, and there's all kind of stuff. And you expanded into the Texas market, it looks like?
So we have our Texas license. So we were formerly known as Louisiana Home Lending. We found out very quickly
Gotta ditch that.
Hard to be Louisiana Home Lending in Texas or any other market for that matter.
Could be Cajun Home Lending.
That's right. Yeah. So we rebranded last year to Neighborly. Just to be a more accessible brand.
I love the
global
name.
brand.
I love the name.
Yeah, for sure. So and we are a brokerage. So we work with a litany of different lenders, about 20. Like I was saying earlier, for a variety of reasons. But number one, to give borrowers that we work with different options. Right, that's our job. And every borrower is not going to fit one lender's specifications and appetite for that specific credit score, or loan product, or loan amount. What we've tried to do as a company is bridge the gap between being a small brokerage and offering the both affordability, scalability, and the options, and the bigger scale lenders that offer a streamlined process. So
what you can do for local people, local families, is probably a whole lot more than what companies like Rocket Mortgage and all these other companies can do.
Yeah, we understand the regional demands here and what the local marketplace looks like, and structuring deals, and not to mention just offering a more affordable product, right? Because I'm not buying commercials on ESPN.
Gosh, so, I know, like Geico, man. Geico's not a home lender or anything like that, but like their marketing machine is wild.
Yeah.
So real quick, you helped over 923 families and counting. Tons of great information here, and there's an about you. So what I'm gonna do is I'm gonna show this on screen for people that want to see this PDF. I'm gonna scroll through it. So if there's any spot that you want to screenshot, obviously feel free to do that. So I'm just gonna scroll slowly here. You got what matters most, and so if you're looking at contacting a lender, and you're looking at maybe contacting Neighborly, this is their information, and we'll also give you their website in just a moment here. This is a little bit about Austin, if you haven't gained enough from that. Austin has tons of community participation. He's the active board member and fundraiser at the Acadiana Center of the Arts. He's part of the UL Life program. And then also he's a One Acadiana member, as am I. And so you have to kind of be that, I guess, if you're in business in Lafayette.
Yeah. It's a pay to play.
Yeah. And then, so for those watching, their website is neighborlyhomelending.com. You could probably just Google it. You can even misspell the word neighborly, I'm sure, on Google, and you'll still get the website. Yeah. So just neighborlyhomelending.com. Check them out. But obviously, there are tons of lenders in town, so we're not saying that you have to pick Neighborly, but it's a great choice. Obviously, they're local and founded local with a local Maurice native.
That's right.
So, guys, that is it. Austin, I really appreciate you.
Yeah, thanks for having me, Ben.
Coming on. And, man, look, maybe later on after this so-called bubble does whatever it does.
We can come back and revisit it and kind of do a recap.
Yeah, see where interest rates are at that time.
Right.
All right, guys. Well, that is it. And we hope you enjoyed the show. And we'll see you on the next Friday. And also, do remember that we have our Apple, Spotify, and Google podcast audio that goes up every week. So if you don't want to watch a video, you can listen to in your car, or you can just listen however you want without watching a video and kind of burning your battery. So we understand that. But anyway, with that, we'll let you go and have a great one.